Investment Committee to order, and our first order of business is roll call. Ms. Hopper?
Teresa Taylor,
Here.
Rob Fechner,
Good morning.
Henry Jones,
Here.
Lisa Middleton,
Present.
David Miller,
Here.
Stacy Oliveris, Madam Chair, I don't think she's checked in yet. Jason Perez,
Here.
Ramon Rubicava,
Present.
Betty Yee.
Here.
Madam Chair, the only one I do not show in attendance as of yet is Stacy Oliveris.
Okay. I'm gonna assume, can we check on her, see if she's getting on?
We
And
will.
then, okay, thank you. And we can move on. We still have a quorum. Next is the approval of the September 14th, 2020 Investment Committee timed agenda. I need a motion.
Move it.
Moved by Mr.
Seconded.
Jones, seconded by Mr. Miller. All those in favor, Ms. Hopper?
Rob Fechner,
Aye.
Henry Jones,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Jason Perez,
Aye.
Ramon Rubicava,
Aye.
Betty Yee.
Aye.
All ayes, Madam Chair. Absent right now is still Stacy Oliveris.
Okay. So then we will move on for now to our executive report with Dan Denise. Go ahead, Dan.
Thank you. Good morning, Madam Chair, members of the Investment Committee and Board. I'm Dan Bienvenu, your Interim Chief Investment Officer, and it's a pleasure to be with you here this morning. Before we dive into today's agenda, I really just want to take a second to express my personal gratitude to the entire investment team, to Marcy and members of the executive team, and to yourselves, the board, for the support I've received. You know, that support has certainly been over my career, but especially this last month as I've taken on the interim CIO hat. It's certainly been a transition, and it's only with this ongoing support and teamwork that we'll navigate our challenges together. So I just wanted to take a moment to express my deep gratitude to everybody. I also want to specifically thank Arnie Phillips for agreeing to step into the interim deputy CIO role. I can attest that too is a lot to take on at first, so I really appreciate his energy and effort, his commitment to the organization, as well as the commitment of his team, both in global fixed income and everybody under Arnie's leadership, for everything that they're doing to take on more to leverage Arnie. We have a really strong team of investment professionals working very hard and pulling together every day, and I'm very proud of the team-oriented culture that we've built. I consistently see displays of this one team, one fund evolution, and all of the support that helps Arnie, and all the support and help that Arnie and I have received really is just another demonstration of this teamwork. And so as a team, we're continuing to execute on the strategy that you, the board, have adopted, even as the pandemic endures, with priority number one, of course, being the health and safety of our team members, but immediately followed by the priority of managing the portfolio through the ongoing market volatility, all the while positioning the portfolio for current and future return generation. So that takes me to today's agenda. We'll start with the usual action and information consent items, of course, and then quickly move on to the meat of the agenda, which is item 6. 6A is the semi-annual trust level review and the annual program reviews of the various asset classes. And this is a critical item where we'll take a holistic look at the portfolio and the business model of the investment office. We'll then move down into the various asset classes, covering implementation strategies, performance, accomplishments, and forward-looking initiatives, with the idea of facilitating your oversight role over the entire functioning of the investment office and the entire portfolio. From there, we'll move on to 6B, where you'll hear from your investment consultants, Wilshire and Makita, as they provide their thoughts on the investment office and on the portfolio. That then transitions nicely to 6C, where our teammates in the Enterprise Strategic Planning Division will cover the results of the survey of the board investment consultants. Then the final item under number 6 is an information item on our plan to review the asset allocation of the long-term care trust. Don Molds, our Chief Health Director, will join us for that item, and he, Eric Baggison, and Christine Reese will walk you through the plan. From there, we'll transition into closed session where we'll be able to cover any topics we weren't able to cover in open. And with that, Madam Chair, I'll turn it back to you.
All right, thank you, Ms. Cependino. So I just wanted Pam to note that Ms. Oliveris is here now, and we can move on to our action consent items, and I need a motion.
So moved.
I have a question on 5D.
Second.
Okay, so I've got a motion by Mr. Miller, second by Mr. Fechner. Mr. Perez, go ahead.
On 5D,
Yes.
let me go back to my notes. Sorry.
Madam Chair, this is Pam.
Yes.
We do need to take a roll call vote on approval of the minutes.
Yeah, that's what. Oh, I'm sorry. He's 5D. We're still on 4. My bad. Let's go do a roll call vote on the action consent item. That we have a motion by Mr. Miller, a second by Mr. Fechner. All those in favor, and Ms. Popper, go ahead.
Rob Fechner,
Aye.
Henry Jones, Henry Jones,
Aye. Oh, aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Stacy Oliveris,
Aye.
Jason Perez,
Aye.
Ramon Rubacava,
Aye.
Betty Yee.
Aye.
Madam Chair, we have all ayes. David Miller making the motion, Rob Fechner seconding.
Thank you. Motion passes. Action consent items pass. We're on information consent items. As I understand it, Mr. Perez wants to pull 5D. I would like to go ahead and talk about that. Otherwise, everything is information consent. So go ahead, Mr. Perez. Jason? There you are.
Sorry, 5D.
Yes, sir.
So the policy on page 7, the policy exemptions, we don't have any, the graph is empty. I'm using Insight too, by the way.
Yes, correct, Mr. Perez. That's basically reflects that we did not have any policy violations during or policy exceptions during that period.
Okay. And then on page 18, what's the difference?
Sorry, Mr. President. Page 18 of which attachment?
5D. Attachment
5D.
1. Attachment 1.
Okay.
Sorry.
Okay, 5D. Okay.
On the right-hand side of the table, what's the difference between exempt and known contractor? How does that system work?
All right.
I'm sorry I didn't get you these earlier in the week.
Oh, that's all right. I'm sorry. We're talking about 5D attachment 1, page 18.
Yes, sir.
Okay, and I'm sorry. Which section is the question on? Sorry, Jason, I'm trying to catch up with you.
No problem. No problem. On the right-hand side of the column, selection, reasons, and notes. What's the difference between exempt and known contractor, exempt, critical time frame, all that good stuff?
You know, I would like to see. I want to make sure I answer this accurately. So let me see if I can ask Kit Crocker to pull forward to answer that question. She has the answer. Jared, can you please bring Kit Crocker into the presenter queue, please?
Yeah, she should be able to share her audio and video.
Sorry, man. I tried to get to questions to you guys earlier, but this was a long week.
No problem. And I believe I know the answer, but I want to make sure you get the best answer. So let's see if we can get Kit to come forward and answer the question.
Thanks.
Kit, I see you, but I can't hear you. Are you there?
Sorry, I was double muted. This is page 18. Are we looking at the spring-fed pool contract status?
We are. Yes.
Okay. And the question is?
I don't understand how the selections and the reasons with the notes, how does that work? Exempt, known contractor. So we don't have to go to RFP or anything like that. I understand, but what's the difference between exempt and known contractor? And then,
Yeah, and I think that known contractor is one of the categories of exemption. But I hate to say I'm not able to explain those in any more detail than that.
okay, so someone we've used before and have a good relationship with. Maybe?
Yes, exactly. Looking at Funston, for example, that certainly applies. And yes.
And what about the time exempt? There's I don't know if that's on 18.
The critical time frame, that one.
Yeah.
And I think that just means there's an exemption if there isn't time to go to a full RFP. But what I would see, I'd feel more comfortable getting you an answer from people who are more expert at this than I am. So if we could get you that, follow up with that information.
Yeah, for sure, no problem.
Yeah.
And Mr. Perez, is there a specific one you have a question on, or is that more just kind of general what the different labels mean?
No, just general what the difference, why do we go have such a short time frame on that, on the second one in that slide?
We had two.
Yeah.
Global Equity, Garland, they're both the same, yeah.
Yeah.
Different funds.
And then on 19, the best practice. So I see the exempt known contractor and the time exemption, but is there a best practice exemption on slide 19?
Boy, I'm sorry. I'm going to have to get back to everybody on that, Dan.
Yeah.
Yeah,
Why don't we do that?
if you guys could get back to all of us on that, that would be great.
Absolutely, we will. So, exempt basically means that we know that we got the contract through an exempt process, and then what follows it is the rationale. But as far as the exactly specifics of the various rationale and then best practice, let us come back to you with a good solid answer.
Okay. Yeah, that'll help a lot. And then lastly, on page 29, the last sentence says there's no further action regarding any external investment resource or transaction required under the regulation. But what about our internal best practice and policy?
Okay, and that I can respond to. So this statement has to do with our compliance with a particular regulation, CCR 557, and we have it really is confined to that reg. So it isn't intended to address more broadly any of our actions, or we have, frankly, as you probably are aware, we have many internal procedures relating to conflicts of interest. And this page, and we can make it more clear going forward, is simply intended to comply with Section 557.
Okay, thank you. That's all I have.
Okay, thank you, Mr. Perez. Ms. Brown, 5B.
Thank you, Madam Chair. Dan, I have a question I'm on just attachment 1 of 5D. the items completed under delegated authority. There's a lot on here, and maybe it's because it's for the quarter, but this looks like a lot of investments. And so I'm going to ask you about a couple of these. I was thinking, though, maybe in the future we could number these just so I could refer to like line 5 or line 6 when I talk to you about these investments. That'd be helpful.
Sure, Ms. Brown. I'm sorry, Ms. Brown. Can I just get which page you're on? So that I can
2
make
of
sure I'm
20,
following?
5D attachment 1, 2 of 29, that list of all the items under delegated authority. We have quite a few new commitments and quite a few additional commitments, and I just wanted to ask you about them. I see a global equity, it looks like a $4.2 billion commitment as an additional commitment. Can you just explain to me what that is? I don't think I've ever seen something quite that large on this sheet, so I'm just wondering if I'm correct or what's going on with that. It's the fifth one down.
Yep, no, I see it. Thank you.
Fourth one down. Fourth one down.
Yes, thank you. I believe that is the reallocation from, as part of our benchmark rebalance, we moved money from fixed income to global equity, and that is into the global equity, the factor weighted state.
Great. So we're just rebalancing for the quarter per our policy.
That's an internal rebalance.
Excellent. We've never seen something quite that big, so I don't think. All right, so 2 down from that, opportunistic strategies, DISCO 3, that's 500 million, right? $500 million. And so I looked up that investment, I read a little bit about it, and this is distressed debt, right? Or stressed debt. Can you tell me just a little bit about that investment?
You know what? This is another one that I think Jean Sue would be the right person to speak to. This is in that private debt space. But let me ask Jared if you could please bring Jean Sue forward to answer Ms. Brown's questions. She'll certainly knows it more intimately than me.
Hey, Jean, you should be able to share your audio and video.
Hi. Can you hear me okay?
Yes, we can.
Yes.
Oh, hi, Margaret. The Pickle Deal, it is a dislocation. Will I say it is a distressed? I probably not, because usually in distress, you usually refer to like more of a corporate. For example, like a company who is doing really bad and then almost not able to function. And they're almost about to default, or it's probably already defaulted. So you will say those are like stressed or distressed. Usually the bond of that type of company originally will trade maybe the 90s or 100, and then in that stress or distressed situation will trade down to 30 or 20 cents in the dollar. So those are more, in general, we say that are more distressed in the corporate land. PIMCO's one is a little bit different. They are looking more in the structured product area. For example, they will buy agency mortgages, which is government guaranteed, but they will be able to source it when the market has some stress. The market itself has some stress, not the company or the collateral has some stress. For example, last time around, when the COVID first started, there are a lot of REITs. They are doing mortgage agency trades, but they have liquidity issues. So PIMCO will be able to come in this situation and then buy things at a little bit cheaper dollar price. For example, they might be able to buy the par bonds at around like $85 to $90 price. And then they will wait for that to pull back to par. And then that is more of this dislocation, say. This is no intent like the corporate stressed or distressed that you will be, distressed for trading or distressed for control. It is quite different.
Great. I just want to be sure, because when I looked up DISCO 3, Bloomberg tells about the fund, it had stressed and distressed corporate. So I was a little concerned that we're doing that. Great. So another question.
They will have it, but it's a smaller portion. PIMCO's main strength is like sourcing things which is safer but not to like the 20 cents that you're thinking about. It's more of in like the $80, $90 price.
Great. Okay, then I have a couple questions on real assets. Thank you, Jean. It looks like we've got some.
I'm sorry, Miss Brown. I have a feeling that I'm going to need Sarah Core for those questions. So why don't I ask Jared, can we please bring Sarah Core forward so that she can be prepared to answer Miss Brown's questions?
Yes, Sarah should be able to share her audio and video.
Wonderful. Thank you. All right, Ms. Brown, go ahead.
Thank you. Hi, Sarah. So the questions are with real assets. It looks like we have a new commitment to Pacific Urban Residential for Multifamily Investors, LLC. And then it looks like we have an additional commitment to the same fund. And so, first of all, why are we investing in multifamily? We think that's a good bet, and considering what's going on with the economy. And then, why do we sort of have a new commitment and then additional commitment? It looks like to the same fund. Just questions about those two.
Yeah, so that's a result of the annual investment process that Real Assets goes through. So every year, staff meets with our strategic managers and reviews their pipeline, and we come up with an acquisition and disposition plan, and those get approved once a year in the May and June timeframe. There can be some investments that were signed but not closed from the previous year's allocation, and so those get approved to roll over. So the new commitment for 2021, and the additional commitment is the rollover from the allocation that was provided last year that they have not finished the projects yet, or they have not acquired the assets yet.
Okay, but it is the same investment, right? Because it has the same date, October 2013.
Yes.
Right.
Yes.
Great. Yeah, and then one sort of point here, Dan, is when we put the name of the investment down, I want to make sure that we are very careful that these line up. So for some of us who are very nerdy and go through, I look at the name of the investment, and then I look at the partnership reports, and then I look at the CAFR, and sometimes they don't match up. So I don't know if we pull these names from the CalPERS system or what, but the name of the investment is pretty critical that it match, especially in private equity. And so I want to make sure we've got the same name going across, and I'll have a question later on about that with in item 6, but I'm done. Thank you.
All right, thank you, Ms. Brown. With that, I don't see any more questions on information consent items. So we will move forward on information agenda items, total fund, 6A. And Mr. Benjamin.
All right, terrific. Thank you, Madam Chair. Jared, I think we can move Kit Crocker back to the attendee room. And then if we can move the other presenters forward into the presenter room, let's bring in Lauren Rossborough-Watt, Eric Baggeson, Steve Carden. I think we've already got Jean and Sarah, and then we could also please bring Greg Ruiz forward.
Okay, I think I got everybody. You should be able to share your audio and video.
I don't see Lauren. Do we have Lauren already? I see Steve. I see Eric.
Okay, just added Lauren in. She should be good to go.
All right, terrific. Thanks, Jared. Okay, so this item is our semi-annual trust level review and annual program reviews. And it's really one of the most important items we'll have in front of the committee this year. It looks at the entire portfolio and business model for both the PERF and the affiliates, and then it digs into each of the asset classes and how they're run. It takes what had been 7 disparate items across 3 meetings and then consolidates them into one cohesive total fund view. And we think this consolidation is a big improvement because it really underscores our total fund perspective as opposed to the siloed views presented historically. Now, the goal of this item is to provide the committee with information about market conditions and the economic backdrop, about performance of the various trusts, both the Public Employee Retirement Fund, or the PERF, but also the affiliates, an overview of the asset classes to aid the committee in your oversight role, and then some of the key business initiatives designed to support and enhance our investment program. The item has 4 main parts. I'll kick us off here by reviewing some of the work around strategy for the portfolio, as well as the business model that supports the management of the portfolio. From there, Lauren Rossborough-Watt will cover an economic and markets update. And then Lauren is followed by Eric Baggeson, walking us through risk and performance for the total fund, inclusive of the affiliates. Then we'll dig into the various asset classes and programs, with the managing investment director representative of each asset class or program providing an overview of their asset class, performance of the class, key accomplishments, and then forward-looking initiatives. The goal was to deliver the content that previously had been covered in a disparate manner, undermining the total fund perspective, and instead consolidate into one report that allows the committee to thoroughly understand the whole portfolio and the whole business model and how they come together. After all, it's the whole portfolio that pays the benefits. We'll also have plenty of time for questions, and we'll pause after each speaker to take any questions that you may have. So with that, let's get started. Can I get the next slide, please? All right, on slide 2, you can see the investment office's mission and vision statements. These were created in alignment with and to support the CalPERS Enterprise mission and vision and the 2017-2022 CalPERS Strategic Plan. Each part of the CalPERS organization has a role in CalPERS mission, and the investment office's role, of course, is to manage the investments. Through that lens, the investment office mission and vision statements were redesigned about a year ago and are intended to remind us first why we exist, the mission, but also how we're going to accomplish it, which is the vision. And our mission was written as follows: to manage the CalPERS investment portfolio in an efficient and risk-aware manner to generate returns to sustainably pay benefits. Now, risk-aware encompasses our investment beliefs that risk is multifaceted and that we'll only take risk where we believe we'll be rewarded for it. But it also underscores the fact that generating 7% assumed rate of return requires risk. So we want to make sure we're taking the prudent risks that we want to be taking. And the word sustainably was also purposefully added when we refreshed it last year in recognition of our virtually perpetual investment horizon, as our job is to generate returns for generations to come. So the mission is the what, and the vision is the how. And here we wrote our vision statement to be as follows: to work as one team with a culture of trust, respect, and accountability to effectively manage one total fund. Now, one team reflects our desired culture of collaboration and teamwork. We all have different roles, but each role is critical in the management of the total portfolio, and we work as a team to achieve the mission. Trust, respect, and accountability are the traits we want reflected in our culture. And one total fund reflects 2 main concepts. First, the total fund is the PERF, the Public Employee Retirement Fund, and the affiliates. And second, the things that happen in the various parts of the portfolio, while critical, are only critical because they support the total portfolio. Again, it's the total portfolio that pays the benefits. So both the why and the how are key to supporting and driving our progress on the enterprise strategic goal of fund sustainability, specifically delivering the target risk-adjusted returns on behalf of our nearly 2 million members. Next slide, please. Thank you. Okay. This next slide was put together to depict the various sub-teams of the investment office and what they're responsible for. The idea here is to show the various programs and parts of the team and how they fit into the running of the total portfolio and business model. All the way to the left, you can see that we have the main strategy and research teams, namely the board governance and strategy team, and then the research and strategy group. These teams are designed to be strategic and forward-looking on topics such as our own governance model, sustainability, and on how we expose the assets we're entrusted with to a set of investment risks in an attempt to earn the assumed rate of return over a multi-generational time horizon. So next to the right here is implementation, and this is where the assets actually go into the market. Note that the asset classes sit here along with trust level portfolio management and opportunistic strategies. Also note that these parts bleed over into strategy and research as they are close to the markets and therefore are a critical part of the team thinking through the long-term strategy. And in addition to thinking strategically, these sub-teams are responsible for portfolio construction, trading, deal underwriting, manager and partner monitoring, and related activities. Finally is the area of monitor, review, and assess, which is where we evaluate and report on the efficacy of our outcomes. Included in this part of the business are investment controls and operational risk, or ICOR, which is all about our operational framework and the control function within the investment office. Next is the investment servicing division, which is where operations sits, business and finance management, and then technology and management within the investment office. And then finally is investment risk and performance, which is where we measure investment risk independently from the asset classes and implementation functions, and is also where we decompose our performance both holistically and granularly to understand the efficacy of our decisions. And then finally, we have our support function, which provides critical business and administrative support across the entire investment office. And importantly, as I mentioned before, we view each sub-team, whatever they're responsible for, as being a key part of the overall portfolio management function, as our role within the enterprise is to manage the portfolio. Next slide, please. Okay, our total fund investment strategy and processes reflect our investment beliefs and our governance and sustainability principles in many ways, whether it's the systematic review of strategies, making sure that the risks we're taking are the risks we want to take, centralized liquidity management, or looking at risk through various lenses. All of our activities are and should be grounded in our investment beliefs and principles. And on this second bullet, where we talk about being intentional and where and how we take investment risk, it's worth spending a bit of time on that. As mentioned earlier, we know that getting to 7% won't happen without taking risk. But we also know that there are prudent risks, those risks that we believe that we can both manage as well as be compensated for. And these are the risks that we want to take, whether it's illiquidity in the private markets, growth equity risk, or other risks. As long as we can manage the risks and as long as they're compensated, these are the places where the appropriate level of risk-taking is prudent. Next slide, please. Thank you. Okay. Fiscal year 2019-2020 brought many unique challenges and opportunities, and I'm very proud of the very hard work of our talented team, along with the support of our executive team and you, the board. I believe that we're able to accomplish quite a lot, including the comprehensive centralized liquidity dashboard and management framework, which helped throughout the year, especially during the COVID-19 crisis. And we navigated COVID-19 crisis together, where within a week, we pivoted from really minimal remote work to 100% remote work and have maintained productivity and risk control throughout this pivot. And I'd be remiss if I didn't acknowledge the excellent work of Christian Farland and the whole team at ITSB that helped facilitate this move to remote working. We also completed this pivot during markets that were as volatile as we see, with equities losing more than a third of their value in about a month, only to recover very smartly quickly thereafter. We were able to manage the holistic portfolio in a centralized and team-oriented manner, maintaining the risk exposures that we wanted and ultimately beating our benchmark. And we didn't skip a beat on the private asset side either, with private equity, private debt, and real assets continuing to both manage our existing investments, but also underwriting desired deals that should be accretive to the portfolio, both through the dislocation and into the future. The investment strategy reviews were quite a success also, reducing external manager relationships and thereby reducing complexity, reallocating approximately $28 billion of assets to internal management, where we have greater control and transparency. And this reallocation takes the holistic perf to nearly 80% internally managed and approximately 95% internally managed in the public markets. This reallocation resulted in cost savings of over $100 million annually in fees, and we know that every dollar in fees that we save is a dollar that we retain to have available for paying benefits. We also advanced our 5-year total fund governance and sustainability strategic plan, accomplishing some major KPIs. We now have at least one female director on the board of every company in the S&P 500, and we released our first ever report in response to the Task Force on Climate-Related Financial Disclosures, with that report being CalPERS investment strategy on climate change. And we've also made some organizational changes to reflect our one team, one fund approach, including the creation of the Research and Strategy Group and the Board Governance and Sustainability Program. And all of the changes that we've made have been directing and migrating from a siloed culture and business model to a one team, one fund approach. And finally, through numerous strategy sessions of the leadership team in the investment office, we developed our next 5-year strategic plan, which resulted in the mission and the vision that we discussed earlier, and also resulted in our 5-year strategic plan objectives, which are viewed through the lens of what we call our 4 Ps, with those 4 Ps being the portfolio, our processes, our people, and then the resultant performance. And it was truly a team effort this year, and I really can't say enough how proud I am of the work of our team. Next slide, please. So I mentioned the lens of the strategic plan as these 4 Ps, and the focal points for each are here on slide 6. For the portfolio, it's all about total fund allocation, leverage, and liquidity, and then about private assets. The keys here are to continue to migrate our focus to the total fund and away from siloed thinking, to ensure that the risk exposures in the portfolio are the desired exposures in both the current time period and also strategically over the long term, and to manage leverage and liquidity such that we can retain those desired exposures regardless of market conditions and can do so in a centralized total fund manner, which is what we were able to do during that COVID-19 crisis. Finally, it's to build our capability and further deploy assets into the private markets where we believe that the risk-return trade-off is a better one. Now, the second initiative is focused around processes, and it's all about institutionalizing transparency, discipline, clarity, and accountability to increase organizational effectiveness. The keys here are governance and decision-making, integrated research capabilities, and then leveraging technology and data in a more efficient, effective, and strategic manner. Now, the third strategic objective focuses on the who of driving success, namely our people. The goal is intentionally aligned to our vision statement, working as one team with a culture of trust, respect, and accountability to effectively manage one total fund. And the fourth objective is around performance. And to some degree, we believe that if we get the first 3 Ps right, the performance will result. The key here, though, is to achieve positive performance, both absolute and relative, delivering our long-term projected rate of return in support of paying the promised benefits. Next slide, please. Thank you. Okay, now on slide 7, you can see that fiscal year 2021 is the first year of our strategic plan, and we have initiatives designed to begin driving progress immediately. Note that this plan is CalPERS plan, and we've already begun executing and have and maintain a great deal of momentum. For the portfolio, we have projects focused on better assets and more assets, including a project on allocation, leverage, and liquidity management, a review of the investment component of the asset liability management process, and then focused work on improving our capabilities and deployment in private equity and in private debt. For the processes, the themes are governance and decision-making, technology and data, and cost effectiveness. For people, this year will be all about refreshing our strategy around our people, specifically how we recruit, develop, and retain our team to position ourselves for success both now and in the future. And for performance, it's all about delivering the desired performance and then measuring and understanding the sources of performance. Next slide, please. So from here, Madam Chair, I'm prepared to turn it over to Lauren Rossborough-Watt to walk us through the current market and economic environment. But before I do, I'm happy to pause for any questions.
So I'm not seeing any questions, so it looks like we can move forward.
Terrific. Thank you, Madam Chair. Okay, Lauren, over to you.
Thanks, Dan. Thank you for the opportunity to speak today. I'm going to speak briefly to pages 9 and 10, providing a bit of an update of information. The main points, however, remain unchanged. The US and the world economies have troughed. What we're watching now is for the pace of the recovery and trying to identify the risks to the speed of the recovery, both upside risks and downside risks. So just stepping back a bit, the coronavirus or COVID-19 pandemic infections rose steadily in June and July across the world as well as in the US before stabilizing at an elevated level in August. In the US, cases increased sharply to around 70,000 per day, but the pace of cases has subsequently declined to around about half this amount. Now, what's important from a macro perspective is that there's been a more targeted approach by governments and states to limit the spillover from affected infection pockets, effectively to help slow the spread and also to stop shutting down economies as what happened in March. In addition, what we have seen is that consumers have become more apt at adjusting to reduced mobility and working from home, and consequently activity has improved to a greater degree than the mobility statistics have. In terms of figures, the global economy has rebounded from its lows in April and May. Q2 GDP numbers have been released. It shows how severe that trough was. In the case of the US, for the first half of the year, for example, the US is now about 90% of its size that it was in the end of 2019. In Q2 alone, it shrunk by a revised 31.7% at a seasonally adjusted annual pace. Now, that's similar to many developed economies around the world, so it's certainly not unusual, but yes, quite severe. So if we look from where we are now ahead to the second half of the year, we've got July data, some August data, and they've been released and they're very positive. Retail sales, both in the US and in many countries, have rebounded to their February levels, if not beyond, in nominal terms. Now, that's quite remarkable when you think about the time frame we're referring to here. JP Morgan Global Manufacturing Output PMI has improved again in August to a figure of 53.6. Now, that's a level consistent with expansion. We've seen global trade volume has bounced from its trough, so it's risen 7.5% in June. That's a month-on-month figure. And in the US, the August employment report showed that unemployment rate fell to 8.4%. So the US economy is rebounding very strongly from its trough. Just on slide 10, you can see the IMF forecasts there. So for the US, they have -8% for 2020 for the US. Now, financial sector economists are forecasting around about -4 to -6% for a calendar year basis to December. So that's quite a noticeable increase from where expectations were in the middle of the year. Going forward, the expectations by most economists are for US activity to continue to normalize, but at the pace of growth to slow. And that's not at all surprising. You get a very large drop, you get a very large bounce back, and then the pace of growth still positive, but to slow over time. GDP is expected to be back at around Q4 2019 levels by the end of 2021, possibly into 2022. What we do know is if the pace of growth slows markedly, expectations are going to rise for more stimulus from the Federal Reserve, possibly on the fiscal side as well. So for now, what we can see is financial conditions are certainly easier than where they were in March and April. Challenges still remain, and there are still risks on the outlook. We've got escalating trade tensions. We've got the US elections in November that are increasing uncertainty going into November. We also have the trajectory of the virus and also a vaccine and how that will be deployed. So the unprecedented situation means that the outlook for both the US and global economies remain unusually uncertain, I guess, is a way to characterize it. But that said, the bounce back has been very, very encouraging. I'm happy to take any questions.
Yes, Lauren, thank you very much. I just had a quick question. You spoke about the possibly needing more federal help for the stock market, federal intervention. Had that stopped? I thought that was continuing.
So there is no conclusion for now. Congress, we are deadlocked. So Democratic Party had a $1.5 trillion effective bill that went through the House. However, the counter from the Republican Party so far has been $300 billion. So there's nothing been agreed at this point.
And I'm actually not talking about that. I'm talking about the Fed and the Treasury buying into the stock market. So.
So the Federal Reserve has adjusted its, I guess, its monetary policy strategy, as it were, to try and attest to some concerns that there have been around the inflation target. But no, not for now.
Okay, thank you. It looks like, oh wait, there we go. It looks like we do have a question from the public, but we're not sure on what part of item 6 they want to talk about. So, yeah, Cherie's double checking. And I'm going to go ahead, Dan, and say move ahead, and then she could let me know and we can stop if we need to.
Great. Thank you, Madam Chair. So next, Eric Baggeson will take us through the review of the trusts, both the PERF and the affiliates, performance, risk, and the like. So Eric, over to you.
Okay, thanks very much, Dan, and good morning to the Investment Committee and also to members of the public that have dialed into today's session. If we can, we've got the next slide up, perfect. This slide is basically a summary of the performance that was generated in the most recent fiscal year. And what the fund returned for the fiscal year, a return of just over 4.7%. And while that 4.7% did not meet the long-term objective of 7%, we're actually very pleased with that outcome. And in particular, compared to the status or the return status that existed at the end of the March quarter. At the end of the March quarter, the fund was down just over 4%. So that's almost a nearly 9% turnaround in the return that was generated. And with that 9% increase attributable to the last quarter of the fiscal year. One of the things that's interesting in the returns that were generated over the fiscal year ending June of 2020 was that the growth asset classes, which are public and private equity, where we normally anticipate the highest levels of return, those categories made almost no contribution to the overall outcome of the fund. The public equity market increased by approximately 0.6%. Private equity, which was valued only through the March 31st date, generated a negative 5% return. And again, I would emphasize that private equity and the private assets in general typically value their assets on a quarter in arrears. So the valuation of private equity lines up with basically the bottom of the market responding to the COVID-19 crisis. The biggest contributions to the return of the fund in the fiscal year came from the more conservative assets such as fixed income, particularly the spread category, which had a nearly 9% return for the fiscal year. The treasury category, which increased by almost 20%, and the real asset area, which had a return of over 4.5%. Also, we had a small contribution from the liquidity segment of the portfolio. When we look at the returns relative to the actual benchmark, the fund generated a positive excess return of approximately 38 basis points, or close to 0.4 of 1%. We're actually gratified by this outcome also. The contributors to the excess return were, again, the fixed income area, predominantly, again, the spread segment, which contributed approximately 14 basis points of that 38 basis point total. The asset allocation work in the fund, and this is partly attributable to doing some rebalancing towards the bottom of the market in mid-March, that effort also added approximately 14 basis points to the excess return outcome. And then the real asset area had a positive relative performance that contributed about 8 basis points to the overall active return of the fund. And this is a significant turnaround from recent history. And I believe part of that turnaround is due to activities such as the investment strategy review that resulted in a significant reduction in the capital that was allocated to strategies that historically have not generated positive contributions to the overall fund relative return. When we look at the affiliate programs, the affiliate outcomes were very much aligned with their overall risk profiles, and the various affiliate funds have very different asset allocations in some instances from that used for the Public Employees Retirement Fund. And the last note I would make on this page is that we now have our official performance being calculated by the finance office. And this creates a measure of independence in the calculations, and we believe serves to increase transparency. If we could go to the next slide, please. Okay, when we look at the risk summary for the fund, we note first and foremost that the overall level of risk in the fund really increased fairly dramatically over the course of the fiscal year. And when I say dramatically, it was about a 1.8% increase in anticipated volatility, which moved the overall volatility levels of the portfolio to approximately 11.5%. That increase in volatility, and again, volatility is only one measure of risk, but it is a significant one. But that increase in volatility is attributable to the risk models assimilating the variability and the volatility and the market movements that took place in relation to the COVID-19 crisis. The risk continues to be dominated by the public equity market. That's basically consistent with the risk profile of the fund for the last several decades. So there's nothing new particularly about that. The active risk levels, or relative to the benchmark, are just over 1%, and that's well within the 1.5% threshold by which, should we reach that level of active risk, basically the staff are directed to return to the board with a plan to try to mitigate that risk and return it to living within that 1.5% threshold. Of that active risk, the great majority of that derives from basically the benchmark misfit that exists in the private asset areas of private equity and real estate. And the non-investable components of the benchmarks that are applied to those various parts of the portfolio. Another dimension of risk could be perceived as liquidity, and we believe that the liquidity of the fund is very strong. That's monitored and managed pretty much on a day-by-day basis. In accordance with the entire liquidity management profile that we've had a lot of discussion with this board over the last 18 months. Right now, we believe we have adequate liquidity to cover nearly 3 times any of the liabilities that would be present themselves, even in a stressed environment. And approximately half of our liquidity is being managed in an overnight fashion, where the instruments that are held in the liquidity portfolio mature basically on a daily basis. So that removes the need to actually generate transactional activity should liquidity need to be raised. If we could go to the next slide, please. Okay, can we get to page 13 on the slide chart? There we go, perfect. This is basically a table that shows performance over several time horizons for the PERF and for the various affiliate funds. I think if you look to the far right-hand side of this table, you'll see the returns that were generated on a one-year basis. And the most recent fiscal year demonstrated a pattern of returns that is atypical to the expectations that we have in establishing the asset allocation for the various funds. And that atypical nature is really demonstrated by the SERP strategies. And there's 3 SERP strategies. And again, those are programs that allow employers to reserve capital and save capital for post-employment benefits that will be due in the future. But the SERP 1 strategy is the most aggressive asset allocation, and it more or less mirrors the asset allocation use for the overall Public Employees Retirement Fund. And then the SERP 3 strategy is the most conservative strategy with the lowest anticipated volatility. If you look at the results for the SERP 1 strategy, that generated a return of about 3.5% for the fiscal year. The SERP 3 strategy, the more conservative strategy, generated a 6.3% return. So you can see that the pattern of returns that were generated in the most recent fiscal year, the more conservative assets were rewarded in contrast to the expectation set that underlies the overall asset allocation activity. Even when you look over the 3- and 5-year time horizons, you still see some mixture of performance between the more conservative and the more aggressive assets. It's only when you move out into the sort of the 10-year time horizon that you start to see the expected pattern of returns starting to evidence itself, where the more aggressive assets of public and private equity as examples start to show stronger returns. But I would point out that that 10-year time horizon happens to coincide with pretty much the bottom of the marketplace during the global financial crisis of 2008 and 2009. So it's indicative of the fact that ultimately returns are sensitive to the starting conditions. And when you have very low valuation levels, there are high expected future returns. When you have higher valuation levels, that serves to diminish the expectation of future returns. If we could move to page 14, please. Thank you. Okay, this table reflects the performance of the supplemental income plans. And these, again, are defined contribution structures that are offered by a number of employers around the state of California to their employees to help them save for retirement expenses. This table, just as the prior table, demonstrates again that the more conservative asset allocations had higher levels of return in the most recent fiscal year compared to the more aggressive ones. And the more conservative asset allocations tend to be the target date 2015, 2020, 2025, a time frame where it's anticipated that people will be retiring in the next 5 to 10 years, in contrast to the target dates farther out into the future, all the way out as far as 2050, for example, which are typically targeted towards younger employees that have a much longer duration to their careers. And the belief that that longer duration implies a capacity to take on higher levels of investment risk. Again, you see in the 5 and 10-year columns, you start to see those columns be more reflective of the anticipated results. And when I say anticipated results, it's the belief that the more aggressive assets, such as equity investing, will ultimately generate higher levels of return. But this is indicative of the fact that you can have significant periods of time when that expectation is not realized. I think one of the other things that's interesting in this table is really the last 2 rows of data. And those 2 rows of data reflect the variance between the stock market outcomes that have happened in the domestic U.S. markets versus the outcomes that have happened in the international markets. So that first row, the Russell All Cap, represents the U.S. marketplace. And what you see is that over recent time periods, and honestly even stretching back 5 or even 10 years, although we don't have a 10-year number on this page, the U.S. stock market has been significantly stronger than the international markets. And the implication of this is that plans, and CalPERS is one of them, that have a global, highly diversified portfolio have tended to underperform investors that have been reflective of a significant home market bias where they have concentrated their investments in the United States. It's unclear whether that pattern will continue. We do believe and continue to believe that international investing ultimately is a rational and a reasonable outcome, basically to create more diversification in the portfolio. But you can go through significant time periods where you will end up with this quite a variation between the results generated in those different domiciles. And if we could flip to page 15, please. Okay, this chart reflects the active return of the fund. And again, it's that excess return. The bars on the chart represent the annual increments of excess return. The line on the chart represents a rolling 5-year period. One of the things I think is most interesting on the chart is that line. And if you look at it, the origin of that line is more than 2% negative. That represents the results that were generated during the global financial crisis, where we, in essence, had very significant negative excess return. And the 2 major contributors to that negative excess return from the financial crisis were, number one, the costs associated with raising liquidity in order to support the activities around the security lending program. And number 2, the very poor relative performance that emanated from the real estate portfolio. And the real estate portfolio at that time had migrated to representing a very, very much what is perceived to be an opportunistic or a higher risk set of investments. There has been, over the succeeding time period, a huge amount of work done to basically bring the real estate portfolio back much closer to be in much closer alignment with the role that real estate is perceived to play in the portfolio. And that role is really centered on generating income and also generating a measure of diversification from some of the equity risk. We were very happy with the relative return performance in our most recent fiscal year, with a positive 38 basis points. And that positive 38 basis points represents quite a turnaround from the pattern of returns, where for the prior 5 years we had basically slightly negative or even flat relative returns. And if we could move on to page 16, please. Okay, page 16 represents a schematic representing the overall risk allocation of the fund. What you see basically is that the risk in the CalPERS portfolio, and again, this is overall levels of volatility, really derives from those growth-related assets of public and private equity. So we basically have a situation where less than 60% of the assets generate more than 80% of the variability in the risk, again, measured by volatility of the overall PERF. We can move on to page 17, please. Okay, page 17 is a very interesting chart that was put together by our investment risk and performance people. And what they've done in this chart is to take our current asset allocation, and they have extrapolated that asset allocation backwards in time for almost 100 years to attempt to estimate what they believe the outcome to the PERF would have been over that time period. I think this chart is very interesting on a couple of different dimensions. So first is if you actually look at the frequency of equity drawdowns, and this is performance during equity drawdowns in the marketplace. So if you look at that frequency of equity drawdown, you just have to seriously ask yourself, you know, is the label like infrequent, if that is applied to the concept of equity drawdowns, is that really appropriate? Because we've obviously sustained a number of equity drawdowns, you know, over that nearly 100-year time period. The other dimension of this that's very interesting to me is also the duration that some of those equity drawdowns can extend. Obviously, the most extreme drawdown duration started in the late 1920s and extended on through the Depression. And what you really see on this chart is that it almost took the conclusion of World War II to ultimately bring risk investing, you know, back to a position of actually being significantly rewarded. So the duration of some of these drawdowns can be pretty material. And this is one of the reasons that the CalPERS staff have such a commitment to attempting to maintain the diversification of the portfolio, which in some cases means basically allocating capital to lower return or expected return assets such as fixed income. And again, in the most recent fiscal year, we saw that return to the more conservative assets being paid off. And if we flip to page 18, please. Thank you. Page 18 reflects on tracking error. And again, this is a volatility-based measurement that represents the active risk in the fund, or the difference from benchmark. What you see is that the active risk in the fund, first and foremost, is a very small proportion of the overall level of risk. So if you think back on that 11 and approximately 0.5% overall volatility, you see that the active risk of the fund only contributes about 4% of the total of that 11.5% expected volatility. So active risk is not a huge contributor to the overall variability of the CalPERS portfolio. And that the inference from that is that the CalPERS portfolio significantly is representative of a benchmark-oriented program. What you see on the right-hand side of the chart is the blow-up of that 4% slice to reflect the fact that the majority of even that small proportion of overall risk is basically generated in large measure by the private assets. And again, that is private asset benchmark misfit or uninvestability. The investment risk and performance team used the label non-actionable in this description. And I actually like that label very much because that is one of the challenges in actually trying to create accountability around the active risk in the overall portfolio. We've been attempting to make some benchmark changes over the last year or so to try to reduce the level of active risk that is not directly traceable to any particular decision made by the staff. And an example of that kind of change is the floating of the weights of the private assets, where they float with market outcomes and on a quarterly basis are reset to their actual proportion in the portfolio. And what that serves to do is bring the calculation of the benchmark more closely in alignment with the actual mechanics of how the portfolio is run. And the objective of that is to, again, remove the calculation or the demonstration of risk that is not the result of any specific decision that anyone can control. And that serves to ultimately increase the degree of transparency on where risk is taken, and it's taken deliberately. And it also increases the ability to do attribution on the kinds of decisions that result in active risk. And that attribution is ultimately necessary to try to create more accountability within the CalPERS staff and then within our external managers. And its accountability as to whether or not those decisions that lead to active risk are actually resulting in an improvement in the overall level of return. I think the last comment I'd like to make before we move on to the next section or see if we have questions is that 4.7% return that was generated by the CalPERS portfolio in the most recent fiscal year, while again that was under our 7% objective, that return in my mind is actually reflects very favorably relative to the majority of the peer universe. I believe our returns for the most recent fiscal year were probably close to 100 basis points in excess of kind of the average of the public fund universe. And there'll be more information about that when Wilshire presents their review later on in the next agenda item. But I think that, we should be gratified with that outcome. And it's a reflection partly of some of the asset allocation work that we did several years ago to basically deliberately incorporate diversifying assets in the fund. And that's one of the challenges that continues to remain, though, is how to retain those diversifying assets, even in the face of lower forward expectational returns. And I think now we could flip to page 19. We can see if there are any questions. Ms. Taylor, do we have questions?
Eric, thank you very much for your presentation. I do have some questions. I wanted to thank you. Also, kind of bringing to our attention the strategies for the SEPs 1, 2, and 3, which shows different risk levels and return levels. And I thought it was interesting. And then again on the target funds. So it's interesting to see that if we wait for the long term and our appetite for risk is, we have an appetite for that risk, then it's going to have a return for it. And I thought that was an interesting way to show that we just have to understand that what is our risk appetite and, for going forward, because we're a long-term investor in it. And it shows that if we're willing to take the risk, we can get the returns we need. Our question I have is from Henry. Go ahead, Mr. Jones.
Thank you, Ms. Taylor. Yeah, Eric, I'm looking at page 11 of 88, 86 of the iPad, where it's the absolute return of 4.7%. That's the chart page I'm looking at.
Sure. Could we flip back to page 11, please?
Yes, okay, that one. Yeah, and you did comment on it. I was looking at the minus 5.1 return of private equity, and we all know that for years this has been our the asset with the highest investment returns over time, even short term and long term. And I do remember you saying that the market downturn was greatest in April or March, and but then when you look at the public equity, it's now positive 0.6 versus the private equity a negative 5.1. And I recall you saying that because it lags a quarter, I think you said that the private equity valuation, so it does not pick up the return for that last quarter in private equity. So my question, if my assumption is correct, is that if and when we get the June numbers, that 5.1 perhaps will disappear also. Is that a correct assumption?
Well, that's certainly what we hope for, Mr. Jones. Until we actually get the
Yeah,
number,
I know you don't have the answer
it's hard
yet.
to forecast it.
Yeah.
What's interesting about this, to get to your question about it, the negative 5% return for the private equity, and again, that lines up with the March 31st valuation activity in relation to private equity. At that point in time, the public equity capitalization weighted benchmark, just as an example, was down more than 15%. So if we lined up the public equity outcome for that quarter relative to the private equity, you still see private equity representing almost a 10% improvement on top of the outcome as of that March quarter. So we're absolutely hopeful that private equity will reflect the increases that we've seen in the public equity markets that have taken place since that time frame. And obviously, they've been very, very significant. And we're not surprised when private equity lags a public equity market that's going up pretty much straight up, you know,
Right.
despite even a few of the bumps.
Okay.
Does that answer your question, sir?
Yes, it does. Yes, and you know, we will. When will we see the June numbers? Quarter ending in June.
Yep.
When will we see the private equity numbers for that period?
Yeah, that information will start to evidence itself, I believe, at the close of the September quarter. Whether they'll actually have it reflected for the September quarter or if it'll take going out into October, I'm not 100% sure. We could get a more precise answer on that for you.
Okay, thanks.
Yeah,
and then
Mr. Jones,
yeah, go ahead.
I'm sorry, Mr. Jones, I'll just jump in quickly. Yes, it'll be the September 30th performance where you'll see that. And anecdotally, what you've seen is as valuations have started coming in private equity space, we've seen those numbers being something like plus 8% for that quarter. So as Eric mentioned, you know, you saw this trough as we came down, but then given the very strong bounce back in the public equity markets, we've seen similar things coming in now. Private asset valuations tend to be a little bit smoother, but you are certainly seeing a bounce back in those valuations coming in.
Okay, so let's just hold our powder for looking at this going forward. The other question, a comment I had was on the tracking error. It's page 18. It's I guess 95 of the. Yeah, and so as you were explaining this, and tracking error to some degree tells us what kind of risk is being taken. And looking at these charts is active risk, and that's the decisions that staff has made that's contributing to the tracking error in terms of risk, and the rest is the market itself is causing the greatest portion of that risk profile in the tracking area. Is that correct? And also, when are we going to have a deeper dive in understanding this tracking error as it relates to the risk that the board is, since we're coming up with our asset management liability process, we need to, I think, get a better understanding of this risk profile.
Well, to answer the first part of your question, sir, the answer is absolutely yes, that the overall markets that CalPERS has exposure to generate by far the lion's share of the variability in the outcome. So as I say, basically, I interpret this chart that the CalPERS portfolio overall is very benchmark oriented. when you only have approximately 4% of your overall risk level representing active risk or different decisions that make the portfolio different than the benchmark, that's basically indicative of a relatively low level of active risk. And even then, when you look at the blow up on the right-hand side of the page of that, the majority of even that difference is attributable to the private assets. So there are really very limited numbers of decisions or magnitude of decisions where there's being risk taken that makes the portfolio dramatically different than the benchmark. And I'm going to have to ask Dan if he's got a time frame in mind as to when we might bring back a discussion more on active risk or tracking error.
We do. Thanks, Eric, and thank you for the question, Mr. Jones. Yes, it's currently calendared for November. So our investment risk and performance team is currently working with Wilshire. And there's a couple of things there. One, to your point, will be to take a deep dive to really understand tracking error. But secondly, to really make sure that the tracking error is serving as a risk limit that the board can feel comfortable with how it's working as a risk limit. So both from an understanding standpoint, but then also making sure that it's meaningful. And that's the stuff that currently the staff and Wilshire are working together on as we speak, with the plan of bringing that to you in November.
Okay, thank you very much.
Does that conclude your questions, Mr. Jones?
Yes, it does.
All right, thank you.
Ms. Taylor?
I have a question from Ms. Middleton. Go ahead, Ms. Middleton.
Okay, thank you. And Eric, Dan, and all of the team, this has been a very good presentation. I really appreciate it. Mr. Jones asked one of the questions that I wanted to ask, but Eric, could you explain a little bit more in detail why there is approximately a 1/4 lag in the results of private equity?
Yeah, I think, truthfully, our private equity people during their program review, Greg Ruiz, and we'll be talking to this, and honestly, Greg may be able to provide a more complete answer than I can, but let me just offer that basically private assets are typically valued off an array of models. And those models look at, for example, the business activity that's underlying. It looks at comparable valuations, for example, in things like real estate. It looks at a number of things that are actually divorced from the marketplace or how publicly traded assets are valuing at any moment in time. And it really takes time for those valuation models to be estimated and then to basically reflect that in the books and the records of these private funds. So it's just the operation of those funds just tends to basically only be able to assimilate that data just so fast. And we literally, it just takes time, for example, between when we see the marketplace moving around and when that becomes evidenced on a more widespread basis through the actual economy. So there can actually also be a significant divorcing between what happens in the underlying economy, and that was the material that Lauren Rosborough was talking about, and then what happens in the financial markets. So you can have a very significant divergence, even while the economy, for example, has been going down during the whole COVID crisis. The financial markets dropped and then have had a huge recovery way in advance of when the actual economics have recovered. So the private assets just have all of this timing difference that they need to be normalized for. And I don't know if Dan has more commentary that he'd care to offer to that.
Yeah, the only thing I would add, Ms. Middleton, thanks, Eric, is that in the public markets, these things are traded on exchanges. So you have pricing continually, and you take the closing price, and then you calculate performance, right? So it's very easy to get a June 30th price because it's the closing price on that day. In the private markets, to Eric's point, what happens, you have all these models, and we receive financial statements over time, and that time just takes time. So the methodology that we have pursued to give ourselves time to calculate this is that it snaps on a certain date, then all the models are run, financial statements are received, all of those things are completed, and then we calculate performance. And that takes approximately a quarter, and that's the reason for the quarter lag.
That makes sense. Thank you. Are there other asset classes that have this kind of divergence in timing?
Yes.
There are, yes.
Real estate. Dan, go
private
ahead.
equity. No, private equity and real assets certainly, and then our expectation is that private debt will be similar because again, it's going to be delayed. But Gene can speak in more detail to that one.
Again, approximately a quarter delay, or is it even longer?
No, a quarter in all cases is the expectation. Certainly in real assets, it's a quarter.
Okay. And I wanted to go back to the slide on liquidity where Dan talked about having 2.9 times the tier 1 30-day stress.
Okay, let's see.
Yeah, I think you went past it there.
Yeah, I think that's page 12.
There we are.
Here we go.
Okay. Describe in more detail what you mean by tier 1 30-day stress.
Yeah, basically, we've taken in our liquidity management framework, assets are in essence tiered, and the tiering refers to what is the maturity profile of those assets. So tier 1 assets are typically assets that mature in a very short time frame. I'm not 100% sure if tier 1 is limited to 30 days or even in closer than 30 days. So we could get detail on that from the people that do this calculation. But what we're looking at are trying to understand assets that will convert into cash through a maturity process in contrast to having to actually sell the asset in the marketplace. So there's just a difference between an asset that matures and you're getting repaid the capital absent any kind of a transaction that needs to be generated. The stress scenario is basically applying what can take place over a 30-day time period. And we've looked back historically to identify these types of scenarios and said, how much can the market move? And obviously, for example, in March of this year, we saw a very significant move in the equity market, which dropped almost by a third in less than a month's time frame. So that's indicative of that kind of a stressed environment. What happens on various liabilities and the demand for liquidity. So what we're saying in this is that given a stress scenario, we believe we've got more than 3 times the amount, or about 3 times the amount of liquidity necessary to meet any liabilities that would come up. And those liabilities derive both from the retirement benefits and pension benefits that CalPERS pays out, but also due to mark-to-markets on things such as derivative instruments. If you're holding futures contracts to represent equity exposure and they go down, you have pretty significant mark-to-markets that you have to pay. And that's what's inferred by that statement, Ms. Middleton.
All right, thank you. Is there a best practice target that you have in this area?
Well, I'm unaware of a specific ratio as a best practice. We think our entire liquidity management framework basically is absolutely best practice. And, that would also be potentially a question that, would be a valid question for you to ask one of your external consultants, for example, such as Wilshire Associates, that looks at liquidity management processes across a number of different kinds of entities. As an employee of CalPERS, I'd like to believe that ours represents sort of the state of the art, but, I think you need somebody else's opinion to basically buttress that comment. So I think it is, and there are different, we're using in general the kinds of definitions and interpretations of these metrics and these statements basically that are generally used throughout the industry.
Okay.
And Ms. Middleton, I'm sorry, I'll just
thinking about following up with Wilshire later on, and I will certainly do that. But liquidity was an issue for CalPERS in 2007, 2008. And so being certain that we are in a strong position today, I think is one of the signs of lessons learned from the last crisis. All right, thank you.
Yeah, absolutely, Ms. Middleton. And I'll say anecdotally that we have actually seen in going through this COVID-19 crisis just completely different experience, where in the great financial crisis, if we didn't know what the liquidity was, we were disparate in our management. That's just sort of a legacy siloed thinking. We didn't have clear sources and uses of liquidity. We just knew that there was liquidity challenges across the portfolio. This time, as Eric said, we have a very clear list of what the sources of liquidity are, what the uses of liquidity are. It's all centrally managed. And this time through, even when the markets were exhibiting stress and illiquidity, our portfolio, our balance sheet stayed completely liquid, and we were continuing to able to, as Eric said, to rebalance the portfolio when needed, to lean into private markets opportunities. It was night and day difference from the last time, and I agree that we think it's to Eric's point, and it's definitely worth asking the consultants, but we feel gratified that it held up the way we expected it to this time through, and that's encouraging.
All right, thank you. Last question I have for you, and you'll probably tell me I should ask Wilshire this one as well, but with the volatility index going from 9.7 to 11.5, Eric, you used the word dramatic to describe that change. So are we approaching volatility numbers that you think are as high as we should go, or where do you see us over the next 12 months in terms of what we should be looking at in terms of our volatility of the portfolio?
Yeah, I think, well, first, let me be very clear that the numbers that we have represented are estimates of the volatility of the CalPERS asset allocation. And those estimates are calculated using our BorrowOne risk platform. So one, those volatility estimates are not what's called the VIX index or the volatility index that's typically used within the financial community to indicate market stress. So that VIX index is much, the order of magnitude of changes of that particular index are much in excess of anything that we're seeing in the calculation of risk around the CalPERS portfolio. But that basically the volatility of our portfolio increased by approximately 1.8%. And again, this is using a relatively longer term model. So it takes a fairly dramatic short-term outcome. And that's exactly what we saw in the March timeframe in particular around the whole COVID crisis to shock that model with that kind of a short-term outcome to generate that order of magnitude of change. My own personal, and this is just a guess, because we really don't know how this is going to evolve, because it's going to be entirely dependent on what happens in the marketplace. And obviously, we have a lot of uncertainties still out in front of us, not the least of which is the upcoming election. We're still in the virus situation. We still don't have, for example, vaccines and things of that nature that we know are going to have efficacy in basically helping to manage that problem. So there's still a tremendous amount of uncertainty and potential sources of uncertainty. But everything else being equal, we would tend to think now that we would basically see the longer term nature of that model start to diminish that risk back down as other observations come in and sort of temper some of the volatility that was generated in that first quarter of the year. And that's about as precise an answer as I could offer.
It's a very good answer. Thank you, sir.
And Ms. Nettleton, maybe I'll just add just really quickly, and this is the challenge of risk management, right, is that it's a mosaic, and there isn't a single number or metric that'll tell you the risk. There's lots of them. I will say that your strategic asset allocation hasn't changed, and therefore the portfolio largely hasn't changed. So the actual risk of the portfolio really hasn't changed. What's changed is, to Eric's point, the historical observations that the model is using have become more volatile, which makes the apparent volatility of the portfolio go up. Measured model volatility is an important metric, but again, it's only one, and that's the reason why we have so many, whether it's liquidity, whether it's tracking error, whether it's total volatility, all of the above. It's triangulating to are the risks we're taking the risks we want to take? And I think we feel comfortable that the answer is yes.
Dan, thank you. To put what I think you just said in lay language, the change in from 9.7 to 11.5 reflects more the changes in the market than it reflects a change in our portfolio. Is that correct?
Yes, you said it better than I did, and yes, that is correct. Thanks, Ms. Middleton.
Thank you.
Ms. Middleton, this is Arnie Phillips. Can I step back real quick to your liquidity question?
All right, thank you.
Our dashboard actually has 3 tiers, a tier 1, a tier 2, and a tier 3, and also takes snapshots over 3 periods, a 7-day, a 30-day, and a 90-day. So we gave you the 30-day, a tier 1 being what we perceive to be better liquidity than, say, tier 3 assets. And I think you hit the real issue, which is in the 07-08 issue. Our portfolio, and I was here during that time, would have likely been considered tier 3 assets. So we have completely, in addition to getting away from silos and having a total fund centralized management of it, the quality and the liquidity of the reinvestment book has gone from basically tier 3 assets to tier 1 assets. So we have much higher quality assets in our opinion. We also have much better view of them. So you saw a single snapshot on that tier 1 30-day. It's broader than that, but I think you got the moral of the story, which is our portfolio is much better positioned today than it was a decade ago.
Thank you. Thank you all.
Okay, so we still have some questions. And I just want to say, I think we all should understand, I don't know if y'all remember when Mr. Mang came in, he started talking about upping our liquidity, which was his plan when he move forward and working to create our total fund and our liquidity. I think that's what set us up for having such a great return. So I just wanted to remind folks of that. It's a shame that we've lost Mr. Mang. And I have first from Mr. Jones a question, and then Ms. Yee.
Yeah. Two questions. A comment and then a question is, as Ms. Middleton said, that the lessons learned, and Arnie mentioned it about the 2008-2009 financial crisis with the huge drawdown on our assets, the impact on our fund. And as we know, regardless of the returns, we still have to pay benefits every month, and $19 billion was still had to go out the door to pay benefits. But we were in a position having to sell assets that were undervalued at the time because we need to generate cash to pay those benefits. So we created an asset class of liquidity at that time. And what is the target of that liquidity asset class? Is it 1 or 2%, Arnie or Dan?
Yes,
Yes,
the
Mr.
current
Jones,
target for liquidity. I'm sorry, go ahead, Dan.
No, I'm sure we were going to say the same thing. Sorry, Eric. It's a 1% target for liquidity, Mr. Jones.
Okay, good. So I just wanted, and I was here in 2008, 2009 also, and I know we took a bath because we didn't have cash to manage the system. So I'm very pleased to see that we've instituted this asset class, and it's paying off now that we're in another downturn market. The other question I had is back to that comment about the evaluating the lagging evaluation of private equity and real estate. That's not just a CalPERS phenomenon. That's throughout the industry. Is that correct?
Correct.
Okay. Thank you.
Mr. Jones, Arnie Phillips again, just to elaborate on that liquidity question. We also have a much different portfolio in the sense that we have a 10% U.S. Treasury sleeve now dedicated to providing liquidity. And that's a much different position than we were in the financial crisis also. So we have that dedicated 1% to liquidity, but we've also made a very concerted effort to make sure the rest of the portfolio has liquidity attributes, ability to borrow against those assets if we need to. And we had encumbered them in a sense last time, and they weren't there. We were making sure this time that those assets can be used for liquidity purposes if needed.
Thank you.
Thank you. Ms. Yee.
Thank you, Madam Chair. I just wanted to just take a divergence for a moment. We're in an election year, and I was just curious with respect to the observation about the market diverging from the underlying economy. At what point, because it seems like before every presidential election, the market does kind of reflect its sentiments about what may lie ahead. And at what point will we see some of that just being reflected in the market, both in terms of the election and I think this time around, a lot of concern about the leadership transition after the election.
Dan, do you want to take a shot at that one?
Sure. I mean, I think candidly, happy to, Ms. Yee, thank you. Candidly, the answer is we're seeing it, right? I mean, you're certainly seeing it in some of the derivative markets on election and in volatility in the outcomes of the election. You know, markets are discounting regimes, and they sort of assess all the different potential outcomes, and then kind of effectively through markets assign probabilities. So you are seeing it, and I think that's one of the simultaneously most enjoyable but also challenging things about investment is that everything is pricing in this way. And I think last time, frankly, I think generally people thought that there would be one election outcome and a certain market response, and then we got the opposite election outcome, but actually that very positive market response. And so that it takes you to this point of constant humility investing in these markets, that we don't know exactly what is going to happen, but what we do know is that if we can maintain our long horizon, we can maintain our competitive advantages and position the portfolio for long-term success, we can see across elections and cycles and the like.
Great, thank you, Teresa.
If I could just, I was just going to offer one incremental comment to what Dan just said, and I think this is really important. We have absolutely no idea what the future is going to bring, and anyone that operates in the financial markets that implies that they somehow or another know what the future is going to bring, that's just witchcraft, basically. That doesn't exist. So our main objective is to make sure that we can respond appropriately and attempt to maintain our risk profile despite almost whatever conditions the market happens to give us. And that's what all of our management tools are designed to help us do, and all of these dimensions, such as the liquidity management framework. So we don't know what we're going to see, but we're pretty confident that we're going to be able to maintain the target CalPERS risk profile through whatever it is.
Thank you. Thank you both.
Thank you, Ms. Yee. Great question. It looks like we can move forward. I don't see any more questions.
All right, thank you, Ms. Taylor. Yes, looks like we went to slide 19. Terrific, and we'll ask Steve Carden to come forward and talk about global equity.
Thank you, Dan, and good morning, ladies and gentlemen of the board and our public. Steve Carden, representing Global Equity. Before I dive into covering global equity, including the program highlights, performance, and accomplishments, I did want to draw some attention to something I noticed in looking at the total deck overall. That is, you'll likely see a number of points covered within the asset classes that have already been covered by the total fund portion that Dan and Eric have covered. And I found this to be a very positive outcome that reflects our total fund focus and the culture that we have all adopted. I also want to pause for a minute as my eyes are itching and throat is scratchy to thank our firefighters. I can't even imagine what they're going through right now, so we appreciate that. And with that, let's take a look at the global equity review. If we could go to slide 20, please. Okay, as you know from the asset allocation work, global equity is the principal asset class providing growth exposure. Our team participates in global markets, and it uses this experience to provide perspective and also some insight to decision-making that happens at the total fund and strategic asset allocation level. Our program is thoughtfully delivering multiple equity betas with low active risk and very efficient cost. In fact, 97% of the portfolio now consists of internally managed low-cost strategies. One thing that's inherent in managing low active risk strategies is the need to rebalance just to remain similar to the benchmark. This often results in meaningful purchases of securities whose weight in the index has increased and sell trades of securities whose weight has decreased. And we see that in our big rebalances. During the COVID-19 driven equity market drawdown that we saw in March, the global equity portfolio's defensive positioning and focus on high conviction strategies did help moderate the impact to the total fund. Now let's take a look at that.
Steve, I'm sorry to interrupt you. Look, we're somehow not getting video. Are you having technical challenges around the video? Oh, there we go. Oh, and we lost it again.
I'm sorry, it says sending video.
Okay, yep, there we go. I know you're in the office, but it keeps kind of coming on and off. Okay, sorry, let's continue and hopefully we're getting the video.
All right, seeing me is not the highlight anyway, so if we could go to the next slide, please. Slide 21. As Eric mentioned, global equity did return about 0.6% for the fiscal year. That's positive 0.6. And that represents an excess return of about 21 basis points. The index-oriented and active strategies were both positive contributors, while alternative beta and emerging manager strategies were a drag on performance. And as Eric alluded to and is expected, the factor-weighted segment provided drawdown protection and diversification when needed, though it did underperform the cap-weighted segment for the fiscal year. Next slide, please. Now I'd like to highlight a few of global equity's major accomplishments for the year. As part of the systematic assessment of strategies that Dan and Eric mentioned, we did review and restructured 3 of our program areas: the traditional active, the emerging manager, and alternative beta portfolios. This restructuring not only led to a higher conviction portfolio, but it also helped us reduce costs of implementation from 9 basis points down to 4. This represented a savings of about $82 million. The team also quickly and successfully adapted to the remote environment, like the entire organization really, and we maintain a strong culture of communication and collaboration that was previously established. Having this allowed us to effectively manage the portfolio, including implementation of a very large quarterly rebalance through extreme market volatility in March and April. And finally, the team helped progress implementation of the Total Fund Governance and Sustainability Strategic Plan. Next slide, please. I want to wrap up with a few comments about global equity's current year initiatives. First, our corporate governance team will continue to collaborate in the development and implementation of a new multi-year Total Fund Governance and Sustainability Strategic Plan. Global equity will also be focused on selecting and beginning implementation of a next generation multi-asset trading platform. Additionally, we will be evaluating strategic benchmarks for the strategic asset allocation work that more effectively capture equity market betas. And finally, global equity will collaborate to integrate risk exposure management across public and private equities. The goal being to identify the best way to measure and manage the combined equity exposure. That concludes my prepared remarks. I'm happy to take any questions that the board may have, or otherwise turn this over to Arnie Phillips. Thank you.
Thank you, Stephen. I wanted to thank you for your presentation. I'm very impressed with the new multi-asset trading platform. I'd like to hear more about that. That's awesome. I know we have heard some. But again, thank you very much for your reports. I think I have a question from, I'm sorry. I had David. Mr. Miller, did you still have a question? Oh, no, your question was that you couldn't hear Steve.
Yeah,
Or see
it
Steve.
looks like
Okay.
Henry's next.
Okay. So, Mr. Jones.
Okay, yes. Could you go back to slide 21? That's 98 on the iPad. It's there, yes. And I'm looking at the factor-weighted net return of negative 2.57. And while we had and I know you kind of alluded to, but I'd like you to expand on it a little bit, because I recall that the reason for going with the factor weighted was to protect the fund on the downside. And I think I kind of got a little bit of what you were saying, why it's still positive, even though it's a negative. Could you expand on that a little bit?
Right. This is really where the impact of the diversification comes in. Even though the segment as a whole underperformed for the year on an absolute basis and relative to the cap-weighted segment, what we did see was that it did not draw down nearly as much as the cap-weighted segment during March. And so the cap-weighted segment being down over 34% and the factor-weighted a little over 30%. So it did provide some protection for us when it was needed, even though it didn't perform as well for the full year.
Okay.
So it's really about the timing.
Okay, thank you. That's relative, right? Okay, thank you.
Thank you, Mr. Jones. Mr. Perez?
Stephen, how does index-oriented, how does that return excess return, right?
Right. It's index-oriented, so as you probably recognize, it has very low active risk, and in doing so, it is not going to deliver big outperformance in any given year. What we see this year for index-oriented, the 22 basis points, I want to call your attention to the very last bullet on this slide, and I know Arnie Filch will cover this a little bit more in the fixed income review, but about half of that 22 basis points I would say is actually not attributable to global equity. It has to do with our low liquidity enhanced return portfolio. And you will see a opposite sign, 11 basis points impacting the fixed income portfolio. So really that, 11 of that I would probably remove for your understanding, which leaves about 11 basis points of outperformance from the index portfolio. And that is a really solid year. But it's really about half of what you see.
Can you dumb that down for me, please?
I think Arnie talking about the other side might be helpful, but the funding source for a lot of what we do is this LLER, low liquidity enhanced return portfolio, and there was a change in how we fund that. From being, focused more, and I forget the percentages, I'll leave that to Arnie, focused more on the fixed income side and I believe treasuries. And at some point in March, we did shift that to putting more of the funding from global equity. And in that transition, it's just more of a timing impact, but there was an accrual of that performance that went to global equity of positive 11 basis points and a negative to the fixed income portfolio.
Mr. Perez, maybe I'll jump in there really quickly. The LLER portfolio is a portfolio of fixed income instruments that are low liquidity, so they're not liquid, and they're a little bit longer in duration than sort of cash, and they're intended to earn a premium over, say, cash. What we can do within the index portfolio is, rather than hold physical stocks, securities, we can own those LLER securities and then own derivatives, own futures over it. That gets you synthetic equity exposure, but actually it would earn an excess return over time. And that's what we saw, is that about 11 basis points of that 22 came from owning this LLER with futures overlaying to get synthetic index exposure, but it was actually enhancing the return a little bit. And then to Steve's point, there was also some timing where we shifted that funding from fixed income treasuries to equities. And it happened at the time when these LLER securities were depressed and then bounced back. So you saw accretive performance in global equity and then actually challenged performance on the fixed income side. At the total fund level, though, they net out to the total performance of the LLER portfolio. That helps.
It does. Thanks, guys, both of you.
Okay. Ms. Taylor, do we have any more questions, or are we ready to move on to fixed income with Arnie?
I think we're ready to move on. I see something from Betty Yee at 11:19 I may have missed.
No, you didn't.
Okay.
Teresa, I'm fine.
All right, thank you. So yes, you can move on.
All right, Arnie, over to you. Arnie, you're on mute.
All right, let's try that. Hi, Arnie Phillips. For this presentation, I'll have my fixed income hat on as opposed to my interim DCIO hat. And Mr. Perez, we will touch a little bit more on the LLER portfolio, so hopefully we can close the loop a little bit more for you there. Next slide, please. So it's good to always remember and remind folks of what one of the main roles of fixed income is to be a diversifier to equity risk. And we saw that work this year. Probably not, as Eric explained, in some of the ways we would have traditionally expected, with our sort of shock absorber being the highest performing asset. But that negative correlation is what we're looking for, and it definitely worked this year. Page 25 in this slide really talks about how we go about adding value in global fixed income. Ever since I've been here for multi-decades, we've had a very structured process. It's changed a little bit in recent years. It's now centered around our weekly portfolio allocation committee meetings, where we focus on economic outlook, relative value among different products, market dynamics, for instance, what Ms. Taylor was mentioning, the Federal Reserve's impact in our markets, and they are strong. So all those types of issues are talked about at our weekly meetings. And it's also something I'm really thankful for. We have very strong collaboration with our centralized research and strategy group. The economic and quantitative teams out of that centralized research group are active participants in our weekly meetings and bringing an outside view to our process to complement what we're doing within fixed income. Next slide, please. So this slide is certainly much more complicated than it used to be, and that's really because we've created out of what used to be a single fixed income portfolio, now the 3 segments. And when you're looking at this chart, it's also good to focus on absolute returns, which are largely driven by our interest rate exposure, which is defined by our strategic asset allocation. And we're designed to have high interest rate exposure. This year, with the COVID pandemic, we saw a move to lower rates. And so lower rates mean higher prices in fixed income. So the income segment had a really strong year this year. I mentioned the 3 segments. In July of 2018, we broke that traditional global fixed income portfolio into 3 segments. 2 sort of indexed focused segments, a US Treasury portfolio and a high yield portfolio, and then an actively managed spread segment. When we look at the US Treasury segment, I look at it really in 2 pieces. We have the management of the fixed income assets, and then we have how the use of that portfolio along with the global equity portfolio fits into our now total fund liquidity and leverage program. And so when you look at the Treasury returns for this year, the Treasury side of it actually had positive returns. And as Steve Carden mentioned, the use of LLER, and Mr. Perez asked some questions around it. We have gotten to the right place now where we are looking at things from a total fund perspective. And we get much better answers, but one of the fallouts can be when you then drill down to an asset class level, you can sometimes get optically a misleading picture. And I think that's what we're seeing this year in the Treasury portfolio. The Treasury portfolio was one of the primary funding sources for the low liquidity enhanced return portfolio, which is managed by Jean Sue. That portfolio has a tremendous successful long-term performance, but through the COVID crisis, it did drop in value and has subsequently returned and realized most of that drop. However, during the crisis, we did make the decision at the total fund level to move the financing of that from Treasury futures to equity futures. And so what we saw was the Treasury portfolio participated in the downside of the LLER portfolio's performance, but then the assets were moved out and the performance return showed up on the global equity side. So from a total fund perspective, we got it right, but it does cause some noise in some of the subcomponents, and in this case, the Treasury portfolio. The second kind of indexed segment is our high yield segment. It's designed to have some growth exposure similar to equities, but be less volatile. And it's really shooting for target index returns, but we do account for the higher trading costs than, say, a US Treasury in the expectation. So we're really shooting for index less 20 basis points. And this year we were down 22 basis points. I am extremely proud of that team. The pandemic had a very big impact on trading of all securities, whether they were equity securities or treasury securities, but definitely high yield securities, given there are less liquid assets. So for us to basically be on our expectation, I'm very proud of the team for that. And if you look at we've only had the segments for 2 years, but the outperformance for that 2-year period is actually 8 basis points. The third segment is the one that's most like the 20-year historical returns you see on this chart, which are extremely strong for fixed income. That spread segment is the one where we actively manage it. We're trying to outperform the index. We were very well positioned going into the COVID dislocation. I do want to be clear, we did not predict COVID in any way. We look at the world from a relative value standpoint through an upside downside lens to determine relative value. And going into that period, call it Marchish, we just felt the upside was somewhat limited given our view of the economic cycle, spread levels, and other parts of the mosaic, which left us really well positioned to take advantage of the dislocations that came with COVID. And the returns for the spread segment this year, especially the relative returns, are outsized and are not returns that we would anyway expect in a normal year, but this certainly was not a normal year. And so the vast majority of our excess return or relative returns this year did come in that March and April period after we saw dislocations from COVID. And then finally, the last item, is liquidity portfolio, which we've talked a decent amount about today. It did have a strong performance year, but I would like to emphasize that return is not the driver of that portfolio. The focus is on capital preservation and maintaining liquidity. Next slide, please. So this slide goes through the accomplishments for last year, and this is probably one that I've been tasked with, and I think I'm most proud of. I think a lot of people expect the good performance out of fixed income, and we certainly had that this year. We have been making a very concerted effort to focus on total fund and become less siloed. And this chart and this slide really details a lot of that work we did with the other asset classes, but also the total fund focus on the 7% solution and the liquidity dashboard, which we did talk quite a bit about earlier. Our global fixed income credit and sovereign analysts did a lot of work this year assisting other parts of the investment office. We did work with real assets, with sustainable investments, with the research and strategy group, with Gene Su's opportunistic strategies group. And I know it's working when I get emails from the likes of Paul Machaka, Ann Simpson, Beth Rickman, thanking the folks who helped them with projects they had. And so it is a focus we're working on, and I believe it's working, and it shows the office's transition to that total fund focus, one team, one fund. And then finally, this was a tough year market-wise. It was very disruptive, so I'm very proud of the strong returns we did have this year. Next slide, please. So going forward, the coming year will in a lot of ways look like the past year. We are going to continue to focus on total fund. This slide shows 5 of the bullet points. One of them we did talk about a little bit in the global equity presentation when Steve mentioned the multi-asset trading platform. It's something that literally the whole investment office is working on. And we see a lot of synergies and a lot of upside to the total fund focus on liquidity and leverage and just managing overall risk. So we do think it's an important project that literally everybody in the office is contributing to. And so fixed income will certainly be a big participant in that this year. But the reality is that we are, the new way we're trying to be here for the fund is really to help anywhere as needed, that one team, one fund focus, and we will continue to see it from our team. So at that point, happy to take any questions.
Thanks, Arnie. Great presentation. I'm just real quick, Arena has a question, but I had one real quick. It looks like on your last slide here, 28 of 88, direct involvement in those LIBOR reform task force. Can you go into that a little bit for me?
Sure. So LIBOR is scheduled, and I think there is some question of whether the markets will be ready to transition away from it. LIBOR is sort of a made up interest rate level. It requires banks to basically post rates every day, and it's not market observed rates. So there's always some question of people's incentives to have it higher or lower. So there's a financial markets reform. Don Ponce is our main architect in the investment office to interact with Washington, D.C. But there's a concerted effort to transition away from a LIBOR-based interest rate for floating rate securities and go to an alternative sort of market rate level that people can observe. And so we have been working with our centralized trading team, with Don Ponce and our market reform, financial markets reform team to have a voice in getting it to where it needs to be, but also to make sure we're ready, whichever direction it goes, to manage the portfolio and make sure if it doesn't happen on a certain day, we're prepared for it. If it does, we're prepared for the alternatives.
I appreciate that CalPERS wants to have a voice given how large we are. I think that absolutely makes sense. Hopefully we do end up having a little bit of a voice. The support of RSG's global research effort on China, emerging markets, et cetera, was my last question. And what can you drill down on that a little bit for us?
Sure. So our sovereign team has a very good understanding and analysis when it comes to emerging markets, which China is not necessarily an emerging market, but they heavily influence the emerging markets. And so from an economic standpoint, the sovereign team within Global Fixed Income works closely with Lauren Rossborough and her folks to kind of get a view of the world. And I mentioned the centralized research impact in our meetings, our weekly fixed income meetings. That's where a lot of that sharing of information happens. Lauren will come in with her view of the world. She'll ask, what's going on with China or emerging markets. The commodity markets are a big impact in the emerging markets. So our sovereign team has a really good view on that. And just putting it all together, I think, makes the investment office output and understanding of very big factors to the mosaic we build when trying to put risk on. Just that collaboration between the two groups is really helpful.
Great. Thank you very much, Arnie. Go ahead, Arena. You're up.
Thank you. I had a question back on slide 26, and it's just asking a little more about the spread category.
Yes.
Just curious about the one that's titled Credit X Sov and the Sovereign, and kind of what the characteristics of those are. Those seem to, even though the whole category performed well, those performed even better. So just curious what those are.
Sure. So that's our corporate exposure. And so that is our investment grade exposure. So the higher quality companies as opposed to what you see labeled as high yield. And those were we were positioned, again, relatively defensively going into COVID, again, because we just felt we weren't getting compensated where we thought we were at an economic cycle and where bonds were trading. And so we were pretty close to home. COVID hits, and at least before the Federal Reserve came in and started buying or committing to buy corporate bonds, the corporate obligations really underperformed. And so our corporate team was, because we were positioned sort of neutral, we're able to redeploy. We don't generally take duration or interest rate bets within fixed income. Where the credit team really is strong is with our credit analysts. And so they have views on sectors and they have views on individual companies. And so when we saw that dislocation, and we constantly talk all day, I know Lou Zahorek is the portfolio manager there, was asking his credit analysts, okay, what are the, 10 best companies you like in your industries that have been impacted by this that we think are really strong companies that are trading more on overall market dislocation and less about fundamentals. And so we were able to reposition our portfolio at that point. Then the Federal Reserve came in, basically supported the market, and we saw, in essence, a round trip of the spread widening back to more current levels. And you'll find us much more neutrally positioned again because we have a round trip. But that's where, again, the collaboration with our centralized research group on our economic views, along with our views of the economy and where things are trading, will dictate our positioning. And we were thankfully positioned in the right way to be able to take advantage of that dislocation that did occur post-COVID.
Thank you. Appreciate it.
And I'm sorry, Ms. Ortega, I'll just jump in also really quickly. That is heroic performance where we shoot for in those portions of the portfolio something like 30 to 40 basis points. As much as I would like to say that we can count on 160 and 102 going forward, I don't think we can. But this was really a tremendous work by this team. And to Arnie's point, our team of credit analysts are very, very strong. And that's one of the reasons why we have such faith in our abilities to deploy in private credit also, is that the sort of the credit DNA within our investment team is just very, very strong. And it's a real credit to see performance like this. I guess it's also worth just really quickly back to the LLER thing. I thought I would just quickly jump in and let the board know that we are planning on pulling LLER out of the asset classes to remove these distortions. So, to the questions that are obviously create confusion, to pull LLER performance out of the asset classes so that neither global equity nor the treasury sleeve will have that kind of distortion, or all be at the total fund level, we think is the right answer, both from a standpoint of transparency and clarity, but then also sort of just kind of accuracy of performance. So that's one of our plans for this coming fiscal year.
Yeah, and I'd just like to add on to that, Dan. The LLER portfolio is managed by Jean Sue. It's a portfolio that we think is rock solid, and I think it fits very nicely into our long-term investment horizon. And if we can take the volatility like we saw in March and April, you saw the additional it added to global equity this year. And when Jean shows a presentation, you'll see the very large numbers that that portfolio has produced over the last 3 and 5 years. And this is really where the difference to Ms. Middleton's comment back in 07, 08, 09 was we had a lot of assets that we thought were ultimately money good, but we weren't considering them low liquidity. We were considering them high liquidity. And in this case, we acknowledge they're low liquidity, but they're extremely high quality. And our ability to basically, through our liquidity positioning, now manage through dislocations, we feel strongly about this portfolio. And it will become, as Dan said, much clearer when we isolate it under, from a total fund perspective, the opportunistic bucket. You'll be able to see the direct impact, and it'll allow the sub-asset classes, in this case, global equity and the treasury portfolio, to reflect more optically what they actually are doing.
Great. Thank you guys very much. Before we move on to our next section, I'm going to say we're at 2 hours and I'm having people telling me they need to run. So let's take a 15-minute break and come back. It's like, let's just do it at 12:15 because it looks like we're 2 or 1 minute to 12 right now. So I'll see you guys back in 15 minutes.
Great. Thank you.